So, you want to learn about investing. Well, that's great, because the average investor in the stock market over the past 10 years, if they invested $500 per month, would have ended up with $94,000 after adjusting for inflation. But the same money kept in a savings account instead would have only left you with $46,000 after adjusting for inflation. So, you missed out on $50,000 because you didn't know what I'm about to share with you today. If you're new here, welcome. My name is Steve Antonioni, and I make videos about money with what I think is a little bit of a different perspective than you're probably used to. But why should you watch this particular beginner's guide to investing? Well, first of all, I currently manage my own investment portfolio, currently worth somewhere around $140,000. Last year, investments that I personally selected earned a rate of return of about 25% since last April, whereas the market average returned about 13%. That's quite a big difference, and we'll talk about this more later on in this video. I built all of this completely by myself, starting 5 years ago with a lot of patience, hard work, and discipline. And the reason that I built this and that I am building this is because I have a goal to be financially free by the time I'm 35, so I can achieve a level of autonomy in my life normally achieved by those who are in their 60s. I won't talk too much about my philosophy regarding investing, money, and life in this video, but if you're curious about that, you can check out some of these videos that I have made. They're definitely some of my favorites. In addition to that, I have over 10 years of experience in the markets. I have a university degree in accounting, and I also have professional training as a financial advisor. With all that being said, everything contained in this video will be predicated upon the experience that I gained from everything I just shared with you. Some of it will be my opinion. Most of it will be verifiable facts, but none of it should be taken to be specific financial advice. And I would really encourage you to seek out additional perspectives to complement my own. All right, so let's go over what I'm going to be covering today. So first of all, I'd like to go over the basics of investing, basically fundamental truths that underpin how it all works. Then we'll go through a series of topics on investing in the stock market specifically, including what the stock market is, why it's a great place to invest, and 3 strategies that you can take with pros and cons for each one. These strategies will rank from the easiest to the most difficult, with the first strategy being the most beginner friendly, and the final strategy requiring much more commitment on your end in order to succeed. And then finally, we'll end with a little wrap up before you head off on your way. So this guide will focus specifically on the stock market primarily, because I believe that is the most accessible way for the average person to be able to build their wealth. But if you are curious about real estate or crypto or other types of investments like that, you can definitely browse through my channel to watch some videos I've made about other things. All right, and with all that said, let's jump into this beginner's guide to investing. As with many things in life, if you can master the basics, then you can master the whole. And I really believe that investing is no different. If you can internalize what I'm about to share with you today, I think you'll be well on your way to growing your wealth over time. Now, the first thing to understand about investing is exactly what we mean by the word investing. And what we mean by investing is that we're going to take some portion of our money and then convert it into something else with the hope of accomplishing either one of 2 things or both. And those 2 things are this thing will increase in value over time, or it will pay me to own it. For example, if you buy a stock that pays a dividend, well, you are now giving yourself the opportunity for that stock to increase in value over time, and you're also going to receive income from that dividend payment, so this investment actually pays you to own it over time. But in a super basic sense, what we're really doing by becoming investors is we are engaging in the relationship between risk and reward. When you decide to invest, what you are really deciding is that you are willing to take on some level of risk in exchange for a reward. You see, when you receive money, you have 2 basic choices. You can either spend it or you can save it. And then with your saved money, you have an additional 2 choices. You can either put that money into something like a savings account where you will expose it to 0 risk and then earn a very small reward. Or you can invest that money into something like the stock market and expose it to a higher level of risk in exchange for a higher level of reward. To some, this might almost sound like gambling, right? And some people definitely do treat investing this way. But I would argue that these investors are misbehaving, because investing your money responsibly is actually a very fundamental part of our economy and advancing society as a whole. So we don't want to misbehave with our money. Ideally, we want to use our money in such a way that it benefits us as well as society in general. And the goal of the investor is to determine the best way to do this. Namely, how can I get the most reward for taking on a level of risk that I'm comfortable with? The most common way that people do this is by investing their money in the stock market. What is the stock market, though? You've probably heard tons of talk about it, but what is it really, and how does it work? The stock market is a very general term. Some people use it to refer to stock market indexes that measure the performance of large groups of stocks, like the S&P 500, for example. When you hear somebody say, "Hey, how's the stock market doing?" a lot of the time, they'll be looking at something like the S&P 500, and that'll give them an idea of how the stock market is performing in a general sense, because that tracks the 500 largest companies in America. But really, the stock market is a very large collection of a series of different exchanges where people buy and sell stocks of various companies. For example, the NASDAQ is an exchange that facilitates the trading of many companies that you're probably familiar with, like Apple, for example. But today, since everything is done electronically and investing apps make everything just super simple and smooth, you don't really need to know all the various bones of the stock market, all the various exchanges out there, in order for you to be a successful investor. I personally think what's much more important is to understand what a stock is and how its value is determined. A stock is a unit of ownership in a company. Companies that have made the decision to allow themselves to be publicly owned, like Apple, means that normal everyday people like you and me can actually purchase these shares of ownership in the company. Pretty cool. So how does that all actually work, though? Well, Apple has split itself into 16.5 billion shares. Yes, that is a lot. And each share is worth $177. So this means that we can actually determine the total value of the company, because we can take the number of shares that the company is divided up into, and then we can multiply it by the price per share. And this will tell us that Apple is worth about $2.9 trillion if you were to try and do something like buy the entire company. And this actually makes it one of the most valuable companies in the world. But here's a question you might have. Why is each share worth $177? Well, the reason why is because thousands or even millions of people have collectively decided that today that's about the fair price for one share. And the way they have decided this is by these thousands or millions of people are trading these shares on a daily basis. And that's the price they arrive at through buying and selling. When you go and buy your first investment, what you are basically signaling to the market is you are saying, hey, if I'm going to press the buy button to purchase this thing, then I think that this is a fair price to pay for it. And if someone is on the other side of that trade selling you the shares, then that means that that seller is saying, hey, I think this is a fair price to sell this for. And then in reality, this is happening thousands or even millions of times per day. And that collective action between all these different people is what ultimately determines what the collective crowd agrees is the fair price. But because the world is always changing, companies are growing, some are declining, the market is changing too. Sometimes there's more buyers who are willing to pay more money for certain shares, which drives the price up. And then sometimes there's the opposite, where sellers are actually willing to sell at a lower price, which can drive the price down. This is why stock values change on a day-to-day basis or even a second-to-second basis. It's a fierce battle between buyers and sellers. And this battle takes place Monday to Friday, 9:30 a.m. to 4 p.m. Eastern Time, to be specific. Here's a little pearl of wisdom to keep with you through your investment journey. And this was a phrase that was coined by Benjamin Graham, who is a mentor of Warren Buffett, one of the greatest investors of all time. And he said, in the short term, the market is a voting machine, i.e., prices can move up and down irrationally. But over the long term, the market is a weighing machine, i.e., the truth wins over long periods of time, and prices should reflect rational information. All right, now that we've had a little bit of a primer on how the stock market works, let's return to the goal of the investor, how to get the most return for a given level of risk that you are comfortable with. But here's the challenge. This part is more in your control, and this part is much less in your control. That's why I believe it is so important to first determine and then attempt to control the level of risk that you're comfortable taking on. But what do I mean by risk? Well, there's two main ways that I think you can think about risk. One is the risk of loss, and the other is something called volatility. Risk of loss is the most obvious. It's that your investment is actually worth less in the future, not more. This is obviously not good and something that we want to try and avoid if we can. Volatility, though, is different. Volatility is how much something fluctuates in value over time. For example, a home generally fluctuates less in value than something like a high growth tech stock. Volatility can be psychologically stressful, and that's because if you have a high volatility portfolio, then your portfolio is changing in value a lot. And this can be a change in value both up and down. Personally, my portfolio, I've seen it drop tens of thousands of dollars, and I've also seen it go up by that much. And I'm personally okay with this. I'm comfortable with that level of volatility in my portfolio. But being uncomfortable is not a good thing because it makes you prone to making errors and it makes it more difficult to manage your portfolio. So this is why volatility is a type of risk to definitely be aware of. So how do we manage our risk then? Well, there's a number of different ways you can do it, and in the investment world, the strategies can get increasingly complex. But one of the most simple and beginner-friendly options you have available to you is using something like today's sponsor, Wealthfront. I chose to partner with Wealthfront on this particular video because they offer a robo-advisor investment service, which is the first investment strategy that I actually wanted to cover in today's video. Using a robo-advisor to invest is, in my opinion, the most beginner-friendly way to invest your money and succeed for the long term. I've personally guided many friends and family members to getting set up with a robo-advisor service. Just last year, for example, I helped my girlfriend's sister get set up with a robo-advisor, and she's making great progress on her investments with virtually no work, no experience required on her end, because robo-advisors use a strategy called passive investing. And honestly, this hits particularly close to home for me because, as I told you in the beginning of this video, I trained professionally as a financial advisor, right? But I did not actually become a fully fledged financial advisor, and that's because I quit. And the reason that I quit is because I grew to kind of see the dark side of the financial industry. I kind of felt that the fee structure many places charged were downright predatory and that the performance was typically not very good at all. Wealthfront, on the other hand, actually solves this problem. For a much lower cost and a much more simple experience, you can invest your money for the long term successfully with, again, no experience or knowledge or work really required on your end. Wealthfront guides you through a very simple setup process and then will help you determine the level of risk that you're comfortable taking on in your investments. And the way that they actually invest your money is what I personally think is the best strategy to invest, and that is through using index ETFs. We'll talk more about the studies and the data behind investing this way later in this video. For now, you can see Wealthfront's historic returns very transparently displayed on their website, and you can even play around with their little calculators, changing the risk score and the initial investment and all kinds of things like that. A robo-advisor can be a great way to start investing and get comfortable, but it's also just as effective for somebody who's already a really seasoned investor. It's a simple, passive, and effective way to build wealth. And honestly, to be fair, do not just take my word for this. Like, please go out and Google what a robo-advisor is, see what the people are saying, see if they also think it's an effective way to invest. I'm confident that you will come to the same conclusion as me, but I want you to be able to verify this for yourself. And if you would like to explore that option more, you can check out the link in the description down below for Wealthfront, and if you use that particular link, you will get your first $5,000 managed for free. Thank you very much to Wealthfront for partnering with me on this video and for helping people build their wealth very easily. Now let's talk about the second strategy to invest your money in the stock market: purchasing ETFs on your own. So you just heard me say that a service like Wealthfront invests your money into ETFs for you, and that ETFs are the best way to invest according to this data that I keep speaking about. This may prompt a few questions, like, first of all, what is an ETF? What's the difference between an ETF and a stock? How do I actually buy an ETF? What's the difference between buying my own ETFs versus doing it with a robo-advisor? And what's this data that you keep mentioning? ETF stands for Exchange Traded Fund. And the easiest way to think about what an ETF is that it is a basket of stocks that you can purchase all at once together. And there's usually hundreds or even thousands of these stocks within an ETF. And since it is exchange traded, it means that you can purchase an ETF the exact same way that you would purchase a stock. So that means you can log on to your favorite investment platform, and just as you would buy any other stock, you can buy an ETF right there as well. But why would someone want to do this? Why would they want to buy a basket of stocks instead of just a couple stocks? Well, let's start with some data that supports why this is such an effective way to invest, and then we'll dive into the why behind it. So no matter which major analysis you look at, whether it's something like Spiva or Morningstar, index ETFs outperform over 80% of professional money managers over long periods of time, so over 10 plus years. What does this mean? Well, more or less, it means that if you choose to invest in an index ETF, which remember is a large basket of stocks that you can buy all at once, according to these studies, you'd earn a higher rate of return than 8 out of 10 professionals who buy individual stocks instead of big baskets of stocks. So listen very carefully to what I'm telling you. I'm telling you that you can go onto your favorite investment platform. You can buy one single thing, like the Vanguard 500 Index ETF, for example, and you will have a very successful long-term investment. Most likely. Obviously, nothing is guaranteed, but most likely. That is literally all you need to do well in the stock market. No researching companies, no learning about charts, no nothing really. Just simply go, press the buy button on this thing every week, month, whatever you want, and then go about your life. Now that sounds nuts, right? How could that be possible? Is it really that easy to do well in the stock market with these ETFs? Surprisingly, the answer is yes. This is like one of those situations in life, you know the phrase, too good to be true? it's too good and it's true. This is not some trick. Like, I highly encourage you to go out, please do your own research, Google these things, look at the various studies, analyses, look at all the stuff out there on them. And I know you will come to the same conclusion as me, but please verify this on your own. And also, for your convenience, I do have several other videos that go more into detail on ETFs, including which specific ones I have in my portfolio and stuff like that. You can definitely check those out too. But for example, if you chose to invest in just one ETF, like the Vanguard 500 ETF, for example, this particular one holds the 500 largest stocks in America. Remember, we were talking a little bit about stock market indexes earlier. The S&P 500, one of the main indexes that people look at to kind of gauge, hey, how's the stock market performing? You can buy an ETF that holds all the stocks in that index. That's what something like the Vanguard 500 ETF does. So you can see here that it holds things like Apple, Microsoft, Tesla, Amazon, and so on. You can check the whole list out for yourself, see exactly what's in there. And if you did this and then held this particular thing for the past 100 years, you would have earned an average of about 10% per year on your investment. Now, if we were to assume that's going to continue going forwards, which it may or may not, obviously no one knows the future, it's just a thought experiment, $500 per month invested into this particular ETF could result in $1.1 million 30 years down the road. So this is why about 60% of my personal portfolio is invested into index ETFs. I can't stress enough that it is just a super simple and effective way to invest your money for long periods of time. Just buy one or a handful of ETFs, toss your money in on a regular basis, walk away. Now, the only catch with this investment strategy is that it requires you to be patient and consistent. You're not going to be rich overnight doing this. That is not the point. Remember, I said we are not gambling. We're trying to be responsible investors. But if history is any guide, it can make you rich over long periods of time if you stick with it. Now, in my opinion, the simplest and most effective way to invest your money into ETFs is doing something called dollar cost averaging. Dollar cost averaging means that you invest the same amount of money on a periodic basis. So something like $500 per month would be dollar cost averaging. It's called dollar cost averaging because that $500 is going to sometimes buy you more units of an ETF or less units of an ETF, depending on what the price of that ETF is. For example, if an ETF trades for $100, then that means when you go to buy it, you're going to be able to buy 5 units of it. But if later that same ETF is trading for $50, well, now that $500 is going to be able to buy you 10 units of that ETF. This is actually great because as investors, we want to internalize the psychology that when we are buying something, low prices are our friend, and when we're selling something, high prices are our friend. But oftentimes, this is the exact opposite way investors actually act in the markets. And that's because low prices is generally surrounded by fear. People are scared. That's why prices drop. And then high prices are generally surrounded by excitement. Everybody's pumped. Everybody wants to get in. But this leads to people selling investments for less money and buying them when they're more expensive. You are buying high and selling low. That is a sure way to lose money. So instead, dollar cost averaging allows us to just cut through the noise and accumulate shares over time. But this works most effectively if you can set yourself to a schedule and then stick to it, whether that's daily, weekly, monthly, whatever works for you, just sticking to it. Even if the market's up or down, doesn't matter, just stick to your schedule. That's when this becomes most effective. Particularly relevant to this idea is an old video I did on a super common mistake that beginner investors make called timing the market. I would really encourage you to check that one out as well. Now, let's move on to our third investment strategy, investing in individual stocks. So as I've just told you, trying to choose and pick and then invest into individual stocks can be much more challenging than just simply buying ETFs. And just so we're clear on the difference here, right now I'm talking about doing something like buying Apple instead of buying a basket of 500 stocks within which Apple is contained. So here's a little bit of an analogy to think about this. Let's say we had a classroom full of students and our goal was to basically choose the students that would result in us collectively getting the highest grade. So one option could be that we actually just pick all the students in the class and take the average grade that they get. This would be the equivalent of buying an ETF. But another option could be that we could try and pick which students we thought were going to get the best grades and only choose them. This would be the equivalent of choosing individual stocks in your portfolio. In theory, this might sound easy enough to do, but in practice, most people fail at this, especially over long periods of time. They're not able to do this consistently. So the question then is, if ETFs are so simple, so effective, then why does anyone try and choose individual stocks instead? There's many different reasons. One reason, for example, is that honestly, some people enjoy picking stocks as a hobby. It's kind of fun for them. But perhaps most commonly, people choose individual stocks in their portfolio because they think they can get more return on a risk-adjusted basis. In other words, they think that for a given risk level, they can get more return picking stocks than they can by just holding ETFs. This certainly can happen. For example, Apple has returned 43% per year over the past 10 years versus 15% for the market average. That's a huge difference. So if you bought only Apple instead of a S&P 500 ETF, for example, you would have made way more money. But as the data shows, this is generally difficult to do. It's generally difficult to pick those exact stocks that are going to have that incredible performance. This is because choosing individual stocks requires much more work, much more expertise, and a healthy dose of luck. The greatest stock pickers of all time spent their days poring over financial statements, getting to know the management of the companies. And they just had a really deep knowledge of commerce in general. And even then, bad luck can ruin your plans. And that's why over the long term, only about 20% of the pros are actually able to outperform people who just buy ETFs. So hopefully that makes it clear as to why for all but the most engaged investors, it probably makes the most sense to just simply buy ETFs for your own portfolio or to do something even easier like use a robo-advisor service. But you may have noticed that hypocritically, only 60% of my portfolio is allocated to ETFs, and I would be remiss to not talk about why that is. While explaining my entire investment strategy is definitely outside the scope of this video, you can subscribe to the channel and check out all my other videos if you want to learn more about that. What I will say is that, first of all, the investments that I have specifically chosen, as I said at the beginning of the video, have outperformed the market average on a risk-adjusted basis that I'm quite happy with. But this was only over a 1-year period since last April, and that is not a very good length of time to make any serious judgments upon. We'll have to wait and see how the future continues to progress before we can actually determine whether or not I have made successful decisions. Generally, it's a good idea to look at least 10 years of data before you can determine whether something was a successful investment or not, if we're talking about long-term investing. But in summary, in addition to my ETFs, I have chosen to allocate a percentage of my portfolio to individual stocks and to crypto because my goals are aligned with accepting more risk in exchange for more reward. And I'm in a very stable and strong financial position to do so. Something that is very important to be in before you even invest in the first place. And keep in mind, this took me over 10 years to get to the point where I felt very confident making these decisions on my own, and that everyone's investment journey and personal financial situation is different. I am not here to tell you what to do. I simply just wanted to share what I have learned over my journey thus far, with the hope that it can be a perspective that complements your own on your own journey. And with all that said, I think this is probably a pretty good place to end this rather long Beginner's Guide to Investing. I would love for you to continue your exploration into this by verifying everything that I've said today. Please. It was actually so long that I just had to switch over my memory card there because I ran out of space. So anyway, I would love for you to continue your exploration into this subject by verifying everything that I've said today. Please do not just take my word for all of this stuff. But if you did find what I've shared helpful, you can also check out a whole bunch of the other videos that I've done on my channel and kind of browse around and see what piques your interest. And one last shout out to Wealth Frontier. Once again, thank you for sponsoring this video. And if you are feeling, pretty overwhelmed by all of this information, remember that they can be a super easy way to get started. So remember to check out that link in the description down below. I sincerely hope that this kicks off an incredible investment journey for you and that it brings financial empowerment within your reach. Thanks for taking all this time to watch if you made it to the end, and I really hope to see you again soon.